Welcome everyone to this session on customs valuation, what could go wrong. Today is a discussion on valuation of goods. It's a hot topic, one of the hottest in customs. We're going to discuss how goods are valued and what issues are top of mind for auditors, and discuss duty minimization strategies. The takeaway, I think here, Dave, is planning first, right?
That's correct. Yeah. And I'm pleased to join you again, Dan and the people at Miller Thomson. And yeah, looking forward to it.
On to the next slide, please, Gus. This is our disclaimer because we're a law firm. We have to say that we're not providing legal advice in this presentation, but if you have any questions, please feel free to contact Dave or I after this presentation by email, or give us a call. Next. Dave, maybe a little bit about yourself.
Yep, I'm Vice President of Carson International. We're a customs broker, logistics company headquartered in Canada, services with U.S. Customs, licensed U.S. broker and licensed Canadian broker. Family-owned business, been in business closing in on 50 years. And I've one of the principals in the company. Up until a few years ago, I decided to step back a little bit, but still enjoy the fast-paced world of Canada Customs and U.S. Customs.
Still pounding the rock. And myself, I am leading the Trade and Customs group in Miller Thomson. We have a team of folks in offices around the country. And I've been practicing in the area of customs and trade law for 30 odd years. And I work with a number of other experienced individuals. So on to the next. So we had a little catchy saying, price is what you pay, value is what you get. These are words of wisdom from the Oracle of Omaha, Warren Buffett. This was in a letter that he wrote to his shareholders. And he said that whether we're talking about socks or stocks, I like buying quality merchandise when it's marked down. And in business, price and value are two sides of the same coin. In customs, the price paid or payable is usually, but not always, the basis for the valuation of goods. So that's the transaction value, is the price paid or payable. And why is customs valuation important, or the valuation of goods important, value for duty of goods? It's because customs duty is assessed on what's known as an ad valorem basis, meaning it's according to their value. Little Latin phrase there for your enjoyment. On to the next, oh, this is it, the WTO. Where all this stems from is an agreement that Canada and its trading partners signed on to, which is the rules included in the World Trade Organization's agreement on the implementation of Article 7 of the General Agreement of Tariffs and Trade, 1994, and that's referred to as the Customs Valuation Agreement. So everybody that's really important within the trading scheme that Canada deals with has signed on to this rules-based scheme, and it's designed to set out a fair, uniform, and neutral system for valuation of goods generally. So the idea is we're wanting to avoid arbitrary decision-making and chaos when it comes to customs valuation. It's designed to avoid sham transactions or fictitious customs values and the evasion of duties that are assessed on goods as and when those duties are implemented. Next slide. Basic stuff, there's 6 methods. The primary method is the transaction value method. I mentioned it earlier. It's the price that's paid or payable. And that's under Section 48 of the Customs Act. That's the primary method. That's the go-to. That's the easy, relatively easy methodology. If you can't get into the transaction value method, then you've got to go through what is referenced as a cascading methodology. You have to consider the next one, which would be transaction value of identical goods. And if that doesn't work, you go on to the next one and so on and so forth. So you can see the last one is the fallback method. That's when everything else fails, you go to this residual method of appraisal, and you have to flexibly interpret or apply one of these preceding methods in a way that makes commercial sense, basically. As I mentioned, customs valuation is hotly contested, probably one of the most hotly contested areas that we see. And every year we see a new round of audits and verifications. We call them verifications in Canada and the US, audits. Importers get tripped up by the rules. And the primary takeaway, as I mentioned, is plan in advance, because it's 100 times more, but anyways, it's at least 10 times more difficult to fix a problem than to prevent it. And sometimes it's impossible to fix a problem when you discover it. And if you have a valuation problem from day dot, the customs agency in Canada can go back 4 years. And so you can accrue a pretty significant liability if you've imported goods over time. You've seen that, Dave?
Yes, yeah, a number of times. It's customs is, and I think you'll note that in the budget, the federal budget on Monday, they made reference to the fact that they're going to look seriously at value for duty, especially between related parties. And so I know we're going to talk about that a little later, but yeah, it's very topical these days.
Yeah, so there's this whole issue of volumetrics, which gets at the issue of if you have a lot of volume, if even a small value good, it can accrue a huge liability over time if you don't get the value right. So planning upfront is great. The transaction value, we talk about the transaction value being the sale price, or where it applies where there is a sale for export to a purchaser in Canada, and the price can be determined. So those are the important things: a sale for export to a purchaser in Canada, and the price can be determined. Sometimes there's difficulties when we've had this, we've had some experience with some problematic areas. For example, a mining company might import huge volumes of bulk ore and import them, and the price is not immediately determinable because it's based upon the London Metal Exchange price at the end of the month. And so how do you deal with that? Well, the way that we dealt with that in the course of a voluntary disclosure, which was like $500 million, the method was to do a provisional, do what your best estimate is of the value at the time, and then go back and check and make sure that the London Metal Exchange value was such and so, and do any true up, any adjustments later on a monthly or quarterly basis. So that's the transaction value method: sale for export to a purchaser in Canada, and the price can be determined. Then you go down other methodologies, the transaction value of identical goods. Essentially, you're using the same idea. It's applied by determining the value of goods based upon other identical goods. So, for example, we might have a matter involving a US company that sells retail apparel to a third party in Canada, and the US company also imports identical goods into a Canadian warehouse. Well, how do you value them? Well, you might go to the identical goods method, assuming that the goods are imported at the same trade level, the same quantity, same transportation costs are accrued. Then it's easy to say, well, the cost or the price that was paid by the third party should be the one that is applied for the goods that go into the warehouse. So that's the identical goods method. On to the next one. Similarly, I mean, you can value goods that are similar. You have a transaction value for similar goods that closely resemble and are capable of performing the same function as the goods that are sold for export to Canada. The value can be adjusted and possibly adjusted for differences in trade level, quantity, and transportation costs. For example, you might have a direct seller of imported candles or something like that. and warmers to representatives in Canada, and slightly different candles and warmers imported into a warehouse on speculation of sale. Well, then you may take the position that the goods are similar goods, and the goods that have been imported on speculation of sale should be valued according to the importation of the goods that have been sold to representatives in Canada. The deductive method, this is applied on a price per unit basis. So you have to calculate what is the price per unit of these things, and it gets a little bit complicated when you have multiple different types of SKUs and goods that are coming in, stock keeping units. So importers may deduct out commissions, profit, and general expenses from the price. So profit and general expenses incurred in selling the goods in Canada. So for example, we have experience in dealing with these types of cases. An importer of retail apparel imports the goods into Canada on the basis of forecasts, bookings, and places them in the warehouse. The importer owns the goods at the time that they were imported into Canada. There is no sale. The importer may use the deductive value where previous methods are not applicable. And generally, this gets you to the supply cost method, which is where you want to be. You don't want to be at the Canadian customer price, because that's invariably higher than the supply cost, the foreign supply cost. You want to be at the foreign supply cost. On to the next one, computed method. This is similar to deductive. It's the cost of production plus normal profit and general expenses that a company in the exporting company would incur when selling the goods to Canadian customers. So, you know, we also have experience with this one. A Canadian company enters into a contract manufacturing agreement with a foreign company to build goods. The foreign manufacturer is paid a tolling fee, and the importer may calculate the value based upon the production costs plus normal profit and general expenses. So that's kind of how it works. And then the last one is the residual basis. That's then like where all else fails, you go to the residual method. You can't figure it out under any of the other ones. You say, well, let's use a flexible interpretation of one of these previous methods that requires the least amount of adjustment and reflects the commercial reality. So any thoughts on all those, David?
Yeah, I guess the biggest thing that's worth pointing out, and I get asked quite a bit, is that these are in cascading order when you can't use the transaction value. Mm-hmm. So you can't pick and choose which ones you'd like to use. You need to start with the transaction value first. And when that's not available to be used or cannot be used, and you cascadingly use it down into residual basis. So that's probably the most important thing, because quite often we see people that say, well, I really like that deductive method. I'd rather use that than transaction value. Well, you can't. You must use transaction value unless it's not applicable to your specific transaction. So.
Excellent point. I mean, you have to, it's a process of elimination. And if you try to skip through this, the customs agency doesn't see the humor in that.
Yeah, and the only two that can be you can go back and forth on are deductive and computed, because it's really just a math exercise starting at a different point. Deductive starting from the sales price and deducting goods out, and computed being starting at the base price and adding. Those are the two that can only be interchanged.
Yeah, and I think you have to ask the customs agency at some point, I forget now, in advance, can I use the computed one instead of the deductive method, or vice versa? So there is a little bit of a process you have to go through on that one. So next slide. Valuation verification. So these are the audits. And as I mentioned earlier, every year there's new audits that happen, and the customs agency kind of gives everybody a fair warning. This is what we're going to be looking at in terms of the various customs issues, valuation being one of them. And invariably, there are targets, and almost invariably apparel and footwear on the hit list, because there's lots of duty on them, 18% duty, I believe. And so issues that they might focus on one year over the next might be assists, like the things that go into the design of a shoe or something, or freight, whether or not goods have been properly, the calculations have been made properly to include freight in the value for duty in certain circumstances and so forth. So every year there is a number of verifications that occur, and the rates of compliance are said to be in the range of 50%. So 50% pass, 50% fail, and out of those 50% fail, what happens is that they get a letter saying it's a post verification, final verification report, post importation final verification report, and it says, we've done this audit. We may have taken a look at several sample transactions, and you didn't do it right. And so we want you to go and do the corrections, and we may require you to go back 4 years or maybe a lesser period of time. And we'll, once you've done that, give you a bill, a detailed adjustment statement, which is a customs assessment. So you have a fair bit of experience with that, David.
Yeah, I think it's worth noting that the biggest questions I get asked are, why did they pick on me? And there's a couple of ways that it happens. Nothing is random any further. This, a lot of times, is Statistics Canada has gone to CBSA and says, there's a big uptick in this importing group, and we'd like to take a look at values or tariff classification. And so that goes from Stats Canada to CBSA. And what they'll do is, and anybody that wants to take a look at, the audit list is, you could just Google Canadian Importers Database, and in there, you'll actually note that Stats Canada publicizes by HS code the names of the top 80% of the importers. If you happen to see your company name in that list, that is the audit group if they decide to pick on a specific HS code. And so that's just, you get lumped in. So if they decided to look at, like Dan was indicating, clothing and footwear, the highest duty classifications, it's easy pickings for CBSA to go in and say, we're taking a look at a men's anorak ski jackets, and therefore they take a look on the site, determine who the group is, send letters out to the entire group, and then start the audit. And they justify that it's a way to use their resources when they're building experience on specific HS codes. And so they start their round. These usually take upwards of 6 months to a year to complete. And they will, if you're found that they're doing things incorrectly, ask you to go back as far as 4 years from date of import to amend those entries. And there's possibly room for penalties if customs believes that you should have known better in the way that you have classified your goods or done things differently. So
yeah, and it's not always just shoes and apparel. I think what happens is that over time, customs finds things and then they spider web out of it. I remember a few years ago, it was fresh cut flowers. The importers were bringing in flowers from South America, bringing them into the US, clearing them in, and then selling them, bringing them into Canada. And they were deducting out all of the freight from South America to Canada. And the CBSA took the position, no, your point of direct shipment is the USA because that's where the goods were imported. And we go on from there. So that's the kind of thing that if you are targeted, you may be part of an industry that.
And a good point, Dan. It's worth noting that once you go through this, they will come back and revisit it to make sure that the entire industry or the bad actors in that target group are in compliance. And they get far more aggressive the second round if you're not deemed to be in compliance. And that's those cut flowers, they stayed on that list for quite some time. So
just a word about verifications. One of the key errors or pitfalls that we see in the handling of a customs verification is the failure to treat the matter with a sense of urgency. So, get buy-in. If you're the customs manager, get buy-in from management to deal with this thing, because it doesn't age like fine wine. It doesn't get better. Marshal the resources, get the resources necessary to pull this thing together, make timely responses, be like a duck, look calm and paddle like hell underneath. And then assign a point person for all communication. And finally, get advice on the tricky issues from people like Dave, who give you a sense of how to handle these things. They've seen these things before committing to a position, especially anything in writing. So those are my key takeaways on handling a valuation verification. Any thoughts on that, David?
No, just like you said in the beginning, pre-planning is a big part of it. And unfortunately, human nature dictates that, you don't adjust your speed limit until you get a ticket from the police officer. Well, it's the same thing. A lot of times companies want to avoid this, just thinking they won't get picked on, and wait till CBSA is knocking on the door. And I think it's best interests of all importers to kind of stop and take a look at, make sure that they are compliant, and that, this day and age of people wanting to do things fast and easy doesn't always get you the results that keep CBSA away from a very in-depth audit. So
It reminds me of what Wyatt Earp would say, fast is good, but accuracy is everything.
right, that's good point.
So anyways, the next slide, I guess we move on to e-commerce and the exponential growth in e-commerce, and how that relates to customs valuation is this: that we see as a result of the sizable digital population, Canada has become a very profitable market for e-commerce. E-commerce has been valued at somewhere in the range of $25 billion. And sales are growing exponentially. So more and more we're seeing e-commerce businesses importing into the country and not necessarily having bricks and mortar in the country, or if they have bricks and mortar in the sense of a lease, or they bought an office or something like that, they may not have mind and management in the country. And so then the rules relating to what's known as non-resident importers may be applicable. So we use the word non-resident importer in a particular sense within the customs arena. It refers to businesses that are not residents, that is, that there is no management and control in Canada, or they don't have a permanent establishment, that is, they don't have a fixed place of a business through which they carry on business. And a non-resident may not be considered a purchaser in Canada unless it imports goods as unsold inventory, on speculation of sale, or on its own consumption or use. So recall that a transaction value method under Section 48 is the price paid or payable. And it applies where there is a sale for export to a purchaser in Canada and the price can be determined. So we'll move on to the next slide. We're talking about sale for export. To show that there is a sale for export, the importer must show that the vendor transferred or agreed to transfer title to the goods. Simple enough. And that the goods were for export to Canada as a condition of the sale. So those are the two key elements. Next slide, please. So in order to show that there is a purchaser in Canada, you got to meet these valuation rules. There's a special customs valuation regulations, I should say. Valuation for duty regulations are formally referred to. And you can be a purchaser in Canada if you're a resident. That is, say you're a corporation that has mind and management and control in Canada. You can be a purchaser in Canada if you have a permanent establishment. That is a fixed place of business through which you carry on business through the operation of one or more employees or dependent agents at that place of business. Or you can import goods as unsold inventory or for own consumption and use. That's how you get to be a purchaser in Canada. On to the next slide. So you can be, we go through this, it's a bit dense, this slide, but an importer can meet the definition of purchaser in Canada, and I talk about resident. Is it a resident? For example, is it a corporation that has management and control in Canada? And I can give you an example of what doesn't work. What doesn't work is a BC corporation with no resident directors. That's not good enough, right? It must have a director that makes management decisions in furtherance of a business. So if you have a corporation with no resident directors, it can't be a resident. And so it wouldn't be a purchaser in Canada for on that ground. It could not be a resident and purchaser in Canada. Move on to the permanent establishment definition. That requires that there be a fixed place of business, say an office or a warehouse, through which the business carries on business through the operation of one or more employees that does some sort of management of the business. So what doesn't work in the permanent establishment arena? We've seen some difficult situations. For example, a US company rents a turnkey office. In Canada, it doesn't have any control over the space. It shares it with other folks. And then there's policy conditions that have been established by the CBSA. It doesn't employ persons to operate the business in the office. The employees don't manage some of the aspect of the business. The business is not held out as through signage or other means as the place of business. These are the CBSA policy conditions that have been established. That doesn't work. You can't get a permanent, the CBSA won't agree that that's a permanent establishment. The last one is unsold inventory. So if you import goods as unsold inventory on speculation of sale, you can become a purchaser in Canada, and that gets you to the transaction value. What doesn't work? Well, say, for example, a US company takes orders from Canadian customers, I should say, buys the goods from its foreign suppliers and then imports them into Canada for delivery to the Canadian customers. The CBSA may take the position that the goods were sold for export at the time of importation to the Canadian customers, and that the goods should be valued on the basis of the Canadian customer price. And so we've seen those kinds of verification decisions or interim reports from time to time. On to the next slide. We've dealt with these types of expressions of interest cases. I'll give you an example, a scenario. A US company not resident and not operating as a permanent establishment may, one, carry out forecasting of global needs, may take information from potential customers who provide expressions of interest, and they're not binding sales. Two, order the goods from a foreign supplier and then allocate some of them for importation at a Canadian warehouse. And then three, make the goods available for potential inspection and delivery and acceptance and purchase in Canada. The CBSA's position in this type of scenario varies depending upon the fact pattern exactly, but they might, the officer might take the position that the expression of interest is an agreement to sell the goods, even though the documentation doesn't support that position, and it shows the opposite, that they're not binding sales. And the officer might say that in this case, the US company is not a purchaser in Canada because the goods are not unsold inventory. And thirdly, that the value of the goods must be based on the next level of trade, that is the Canadian customer. On to the next slide. The result, if the CBSA takes the position that the expression of interest are sales, and the value of the goods are made on the basis of the sale at the next trade level, that is the Canadian customer, then it's not great because the goods will have to be valued at the highest level and the potential duty is increased. So we've cobbled together a rebuttal on this particular point. And we've successfully advanced this position, which is this, that the importer in this type of situation is the person who has title to the goods at the time of importation. And this is supported by the Mattel case. So if the non-resident importer, the US company, has title to the goods at the time of importation, that's a good thing. The government will say, well, it's not a purchaser in Canada for the reason that the goods are subject to an agreement for sale. But then we would go to the deductive method. And we have done that. We've said, well, you can't apply the transaction value because the US company is not a purchaser in Canada, because you say that there is an agreement. We don't agree with that. But if you're right, we'll assume you're right, we would submit that you use the deductive method, which results in the valuation of the goods based upon their supply costs in any event. So all that to say that there are arguments that can be advanced, even if you don't fit squarely within the purchaser in Canada definition and you don't fall within the transaction value methodology. I hope that wasn't too tortured of an explanation, but David, if you have any other comments, please.
Yeah. So based on prior experience, and this is probably where Dan and I have been involved a fair bit, is unfortunately there's a number of customs officers that will take this attitude that, and just going to use garments and footwear because we've seen the greatest increase on those kind of audits. Is that in that it's commonplace for a term to be used called bookings. And so bookings in the trade is really an indication of a sale between two parties. And it's really just something that gives the non-resident importer an indication of how much he needs to purchase, and then turns back around. And so we've been successful, not at the primary level with a lot of customs officers, but it's usually we've had to appeal to management or to Ottawa to ensure that they understand that these bookings are not a binding agreement. And I guess it just, the word of caution is you need to document this. And so if customs comes in and they believe that any type of agreement, the language is so vague that if they believe that agreement ties the parties together, then that's what caused the sale, and therefore the value should be at the highest level. Not at an expression of interest where you can demonstrate that there's no purchaser in Canada. So I mean, it's a slippery slope, but if you do it properly in advance and make sure you've documented it, and things like not having purchase orders in place, we see people that have bookings in place, and however in their system, their SAP or ERP systems, it actually notes that the booking goes in and then it logs it into a PO. That's kind of a mark against you, because if customs comes calling, they'll ask to see documentation between yourself and your customers, and then it'll be on a PO screen, and then you have to try and explain it's not really a PO, it's a booking. Well, maybe see if you can change an ERP system to anytime you have a Canadian postal code in Canada, change that to a booking from a purchase order where you'd issue it in the United States. So again, it's all, if you do things in advance, customs is more apt to take the story. If not, then you're backpedaling and you're trying to produce and justify your position after the fact. And I have to give kudos to specifically Dan and his team, because a number of times I start the argument with customs, but I'm a licensed customs broker, and sometimes they won't take my version of it unless a trade attorney comes in and presses the point with some legalese, which Dan is very good at doing. And so far, Dan is pretty much 100% on defending companies that, in fact, when there is no sale that's taken place, and justifying it. So yeah, I'm not sure if that simplified things or more complicated things.
Yeah, I think you're right. I mean, the bottom line from my perspective is, you're going to use the expression of interest or bookings methodology, make sure you state there is no sale. and that the person that's placing this expression of interest or booking has the right to inspect goods and accept or reject the delivery of any or all of these goods, and so forth. So those are the types of things you don't want to have it show as a purchase order, because then that will lead the inference that there was a sale prior to importation. Okay, on to the next one, related party transactions. This is another area where it's a potential pitfall. The method here, there's special rules that apply, and the reason that they are there are to avoid a circumstance where the parties, we'll say an American company and a Canadian affiliate, artificially suppress the value of the goods to avoid payment of duty. And so you can see how related parties might want to do that. So these rules are there to show that the valuation of the goods is commercially reasonable, for want of a better phrase, right? So how do you do that? Well, you can examine the circumstances of sale to determine whether or not it influenced the price. So if you're going to use the transaction value, you have to show that the relatedness did not influence the value. And the form of proof may be a transfer price study, determining whether or not the margin that the Canadian or the American company has put on the goods at the time of sale is within an acceptable range, right? And show, you can also show that a price closely approximates a OECD test value. So there's particular rules on that. Next slide, please. On to the next slide. There we go. So special rules for calculating OECD test values. You can see them there. Again, you go through the identical goods or similar goods, the transaction value, the deductive value, the computed value, and you determine whether or not it closely approximates one of these test values. On to the next slide, please. In Canada, the transfer price study is a good starting point for advancing the position that the value should be accepted and that the relatedness of the parties did not influence the value, and you get to where you need to be. In the US, it's a little bit different. A transfer pricing study does not necessarily hold the same value. Circumstances of sale test will be considered. Issues to be addressed in a circumstances of sale test include whether or not the price was settled in a manner consistent with normal pricing practices, or was settled in a manner consistent with the way that the seller prices goods for sale to unrelated parties, or is adequate to ensure the recovery of costs and a profit margin that is consistent with the firm's overall profit margin in sales of merchandise of the same class or kind. So those are the types of considerations that go into a circumstances of sale test in a related party transaction context. Next slide, please. As I said earlier, CBSA usually accepts a transfer pricing study as a starting point. There are some exceptions. We had a case involving the sale of autos from an Asian auto manufacturer, a Canadian affiliate. There was also a US affiliate. And so there was a $177 million downward price adjustment that was made. And the reason that happened was that the Canadian, it was necessary to ensure that the Canadian affiliate's profit margin was increased so that it reported an adequate amount of income for income tax purposes within an acceptable profit margin range. So the price of the goods went down, but the Canadian affiliate paid more income tax. So the Canada Revenue Agency was all okay with it, but the CBSA had difficulties with the particular concept and with the adjustment. So those are the kinds of situations that you might run into when there's an advanced pricing agreement or a transfer pricing study or those types of things that are happening. They can get complicated. On to the next slide.
Yeah, actually, Dan, I'm just going to interrupt you. Before you go into first sale, I just want to make a comment that this is something that's topical globally and is brought up at the World Customs Organization. Is a lot of brands that are global brands are doing their best to realize profits in countries that have the lowest tax rates. And so it's one that it's on everybody's radar. And just a word of caution is that the value you declare for customs is not always the value you declare for business taxation purposes, because there's different deductions and additions. And it's just in some cases where, you know, I'm always concerned with the getting the lower value for duty for my clients. Some, you know, and I do have a couple clients, they've actually been targeted that they believe that their value is not high enough for customs because, and they would, Revenue Canada would like to see them realize more profit in Canada, therefore paying more tax to the Canadian government. So it's just something that people need to be aware of, and it's certainly on everybody's mind. And, you know, I can think of a couple brands I deal with, they have VPs of taxation that their entire job is to maximize shareholders' profits by staying on side of rules around the world, but being taxed or creating revenue higher in lower tax regime countries than higher ones. So just word of caution.
Yeah, so there's tax transfer pricing rules, customs transfer pricing rules, and they're different because there's different legislation and different adjustments required. So, first sale rule. So we get a little bit into the US valuation rules, and the first sale rules is something that's a little bit different than we have in Canada. It says that where there's multiple sales of goods prior to their importation into the US, the first sale allows importers, in some circumstances, to use the price paid in the first or earlier sale as the basis of the customs value of the goods rather than the price that the importer ultimately paid for the goods. So there's a person just prior to the person that the importer paid for the goods that is considered the value that counts. So under US law, the preferred method of valuing imported merchandise for customs purposes is the transaction value, of course, similar to here. When the transaction value is required and the goods are sold for more than once before they are actually imported, that is a sale involving a middleman. The first sale rule allows the earlier sale to be used in declaring the customs value, as long as that sale can be documented as the sale for exportation to the US and the importer meets other customs requirements. So this is a customs planning rule that is of benefit to US importers. And Dave, you've got a lot of experience with this.
Yeah, and I want to note that this is a bone of contention with the World Trade Organization, because the United States is the only country in the world that allows this. And they've defended it, and they're on record telling the WTO that they're not changing. And so a good example is you can be located in Vancouver, British Columbia. You can be purchasing something from China. And if you've already sold those goods into the United States, our US office can take your purchase price from China. And even though you sold those goods, and normally we went through the transaction value, if you bought them for $100 and you're selling them for $200, the transaction price is $200. With your purchase agreement from your vendor overseas, we can declare that legally to US Customs under the first sale rule using the $100 value. And that's very unique to the United States. So,
on to the next slide, please. we mentioned a bit of a development that's happened. Dave and his team have alerted us to this, and we've taken a look at it. And it's this Mayer Corp versus U.S. decision, the Court of International Trade. It has potentially wide-ranging implications as it questions the applicability of the first sale rule to transactions involving non-market economies such as China and I believe Vietnam. The importer in Mayer purchased China origin cookware sets and Thailand origin cookware sets, including China origin components. Both sales channels involved related middle persons in Thailand, although a second middle person in China also sometimes participated. The issue was whether or not the importer could use the transaction value price that a related middle person paid to the related manufacturer, even if both were located in Thailand, and that is the first sale price. So the result in Mayer suggests that US customs law might prohibit importers from basing dutiable value on the transaction value of the goods if the sale to a middle person is between related parties and the goods were, for example, produced in a non-market economy like China and Vietnam, or produced in a market economy like Thailand, but incorporating non-market economy inputs, or bought or sold in a non-market economy entity, regardless of where the goods or inputs that they incorporate originated. Next slide, please. So maybe go back for a second here. The reason is that the CIT, I should say, assumed that because the US did not recognize China as a market economy, an importer either originating in Canada or incorporating China origin inputs or obtained from a China-based middle person has an added burden of demonstrating that the buyer procured the goods at undistorted prices. We recall the uninfluenced price that Canadians are worried about. In this case, the court was concerned about having undistorted prices. And so they wanted a certain level of assurance that goods coming from a non-market economy actually were not distorted prices and they were not, suppressed artificially, for example. What's the impact of this case? Well, we take note of it. It need not act on it yet. The decision could be interpreted as limited to the factual circumstances of the case. For example, the importer didn't provide sufficient documentation in the form of financial statements to show that related party prices reflected arm's length prices, undistorted prices. And secondly, this case could go under appeal, and the U.S. Court of Appeals for the Federal Circuit is the place where it could go, and that could be overturned. So that's basically where things are at with this first sale rule. It's an issue to watch, particularly if you have middlemen, middle persons in non-market economies. So watch for further developments on that. So at the end of this, I would like to just sum up with a couple of takeaways. I would say this, that importers can avoid disruptions and realize dividends from proper planning. Secondly, planning rules can be detailed, and careful documentation and execution is important to success. Thirdly, policies and cases can result in changes to the interpretation of the valuation rules, as we've just seen with respect to the first sale rule. And fourthly, it's important to stay current, and your customs broker can keep you up to date. Dave, over to you.
Yeah, I just want to end by, I don't think you noted it, but it was a slide in the beginning that it's kind of like quoting Albert Einstein: everything that can be counted does not necessarily count. However, everything that counts cannot necessarily be counted. And so it's one of those that, value for duty sounds fairly simple. If you're sitting at home and you're buying something, you prop down your Visa card and you buy something and it imports at that price, and there's a good chance that that qualifies. However, not all transactions are like that. So it's just a matter of doing some homework, and like Dan said throughout the presentation, planning sometimes is worth the investment versus waiting for CBSA or US Customs CBP to be pounding on the door asking, how did you come up with your valuation method? So I just want to thank Dan for his presentation, and you know, like it says on the screen, if you have any questions or comments, certainly reach out to either one of us, and I'll turn it back to Dan to wrap it up.
Well, it's always a joy and a pleasure to see you, David. And folks, thanks for participating in this presentation. We look forward to having another session in the near future on another hot topic. And we wish you a good day.
All right.
Stay safe and be well.
Bye now.
Bye.